We have a great panel today, each with varied and deep experiences in the field of compensation and incentives. And rather than my dryly reading their impressive bios, I will have each of our panelists give a brief introduction of themselves, starting with Emma Battle. Emma, will you introduce yourself, please?
Hello, good morning, everyone, and thank you for having us in this opportunity to share with you our thoughts and experiences about executive compensation. I'm Emma Battle, and I am the current chair of the board of New Skin Compensation Committee. I'm also on the board of directors of Bassett Furniture and Unify Incorporated out of North Carolina and Virginia, and I'm on the compensation committee at Unify Incorporated. I'm coming to you from Massachusetts. I'm originally from North Carolina, and it's great to be here today. I won't go into a lot of detail because I know you want to hear about compensation and not about me.
Emma, thank you. Jane Carr. Jane, will you please introduce yourself?
Thanks, Jonathan, and also thanks to everyone for having us. I'm really looking forward to this conversation. My name is Jane Carr. I am the SVP of People and Culture here at Traeger, which is a publicly traded company. So we made the transition from private equity to public company in 2021. And my background prior to Traeger is broad. I spent many years at Goldman Sachs working on a number of different types of compensation programs across the firm there, and have also spent time in Target. And my career before my career was in the ski industry. So for those of you that are here in Utah, born and raised, you probably speak the love of the mountains like I do.
Thank you, Jane. Thanks for participating today. And Alec Lentz. Alec, will you introduce yourself, please?
Good morning, everyone. Alec Lentz. I'm a partner at FW Cook. For those who may not have heard of FW Cook, we're the largest, longest standing independent executive compensation consulting firm. I've been based out of our Los Angeles office for coming up on 15 years now. And I've worked with a large variety of companies in different industries, different company sizes. And in addition to the sort of ongoing public company compensation committee work, I have a fair amount of expertise advising pre-IPO tech and biotech companies.
Great. Thank you, Alec. As you can see, we have varied experience. We have someone from a compensation consultancy. We have someone from management and someone who serves on the board and on compensation committees. I will say those were modest self-introductions, as will become apparent as we jump into the topic and hear more from each of the panelists. So let's begin straight away. Alec, I'd like to start with you. What trends are you seeing in executive compensation, particularly incentive plan design, and how do these impact company-wide compensation and incentives? Two questions.
Sure. So, over the last few years, there's been significant global events that created a lot of volatility for capital markets and had varying impacts on companies across different industries. Many companies became challenged to maintain their previous incentive compensation plans, but they were still under pressure, of course, from shareholders, from proxy advisor firms, to continue keeping the majority of executive pay linked to performance. So in response, a lot of companies have been adopting strategies to de-risk their executive incentive programs by some degree. For example, increasing the number of metrics used, adding a relative TSR modifier on top of financial performance goals, shortening performance periods from 3 years to 1 or 2 years, and also increasing the width between the threshold and the maximum performance goals to make it more probable to land on that payout curve, but at the same time, making it harder to earn a high payout. As far as how these executive compensation trends impact company-wide incentives, there's not a large impact per se, because so much of the focus for executive compensation is on PSUs, which are not typically granted below the executive level. But where companies are making adjustments to executive bonus plans, the expectation is to, also have a look at employee bonus plans to make sure that there's not going to be an undesirable misalignment after performance is measured.
Great, thanks, Alec. Emma, anything else to comment on incentive plan design and trends that you're seeing?
Yeah, I think it's really got to be tied to what's going on in the company and the market and the place that the company's competing in. Because in addition to the challenges that Alec talked about, we've also seen, particularly for traditional companies, undervaluing in the marketplace. So the stock price may not reflect what's actually going on in the company, which makes then another challenge come into play, which is retention of key talent as you work through, different things. So then you got to look at the compensation plan and say, okay, not only do we want to drive shareholder value, not only do we want to see, growth, but we also want to retain talent so that we can keep that going. So that is something that a lot of companies are also facing is, performance is important, but you can't perform if you can't keep your people.
Yes, for sure. Jane, what are you seeing with different generational trends? Are there things occurring in your workforce that are generational, the value of compensation perhaps versus a mission, vision, or purpose? And how's that impacted what you do at Traeger?
Yeah, I mean, it's definitely something that we're seeing. Not so much at the executive level as we are at the more broad levels of the organization, but we at least Traeger, we're seeing an increasing number of people say what's really important to me is feeling like I'm part of a broader purpose, a mission, vision, and purpose. And so that's something we're very, very intentional about communicating out. And for us, it's a balance between how do we make sure that we're clear about this is still a business and these are our financial objectives and these are our strategic goals, and balancing that communication with what we're drawing. So, we are seeing it's an interesting trend. I think you can't assume that compensation is going to solve retention completely. I remember learning a phrase years ago, which is compensation just can't be a detractor, but it's never going to be the thing that satisfies somebody to retain, to stay long term. You have to make sure, even all the way up to the executive level, people are feeling like they've got a purpose, but that they're also getting something professionally and they're growing and they're being stretched. It's not just compensation that's going to solve the long-term retention issues.
I think that's a great point. Compensation cannot be a detractor. My experience is that when people get a bump in compensation, they're pleased for a time. And sometimes that time is not as long as you think it would be before they think, well, I'm undercompensated. They begin to think that again. So I do think that purpose and that meaning at work is an important thing that we all need to think about. Alec, a question's come in from Lisa Padilla of our audience today, interested in learning how board members can be fairly compensated at companies in various stages. There's early stage, pre-revenue, revenue, going public. What are you seeing on the board compensation front industry-wide as a consultant?
So board compensation trends and pay levels tend to move pretty slowly and steadily, as well as in terms of their design. For larger companies that are public, it's the equity grants are now almost exclusively in time-vested RSUs that vest within a year of grant, which usually happens at the annual shareholder meeting. And it does scale with market cap. So the higher the company's market cap, the larger the equity award typically is for directors. For earlier stage companies, pre-IPO companies, the whole pay model tends to be entirely different. It's often based on sharing rates as a percentage of the company, so points in the company rather than dollar values for the equity component at least. And some companies, quite a few that I've worked with actually that are really early stage, privately held, may not even provide very much compensation to directors at that point just yet.
Okay, thank you. You know, one of the trends that we're seeing broadly is increased regulatory developments, both proposed and finalized regulations. And I'm curious how those are impacting compensation and incentive structures, and how those changes impact how you do things. Emma, any thoughts on that?
Well, definitely regulatory compliance is essential, particularly in our industry. And so as we learn about different regulations that are coming down the pike, we look at for example, in direct selling companies, we've been under a lot of pressure over decades for how we compensate not just our executives, but even people at the lowest level. So compensation committee is very, very concerned about making sure that we are adhering to not just the current regulations, but that we are gearing up to make the change to adhere to future regulations. So we have people who are in tune on what's happening, and we are hearing that there are going to be some regulatory changes, and we're already looking at our compensation model from the bottom all the way to the top to make sure that we are going to be in line with those changes when they occur.
Yeah. Jane, any thoughts on how the regulatory environment is impacting compensation and incentive trends?
You know, I think it's very similar to what Emma said. It's something that we have to be very conscious of and very intentional about. I think something that we're also intentional about as we think about working with our committee chair to plan our agendas is making sure that it doesn't dominate the conversation, though. At times it can feel like there's a lot of legislation on the horizon, and it can be very easy to get distracted into where is this going? What is the intention? How are we going to navigate it? But really being intentional to say that is important, but there are also equally important, if not in some ways, more important things that we have to make sure that we're dedicating time towards.
Great point. Committee meetings should be more focused on running the business, not solely on governance. I've noticed that in the boards I've been involved with, that some of the regulatory developments have led to greater transparency. What's disclosed in the proxy statement changes from year to year. It's not, we can't just cut and paste last year's and have it this year. So I think staying abreast of regulatory developments is important so that we comply and so that we get that kind of mood of what shareholders want. Speaking about what shareholders want, how are proxy advisory firms, places like Glass Lewis and ISS, impacting how companies set up compensation? Al, could you give some thoughts on that, please?
So I'll start off by saying that the proxy advisor firms should never be viewed as driving business decisions at companies, including around compensation. It's really important to understand their perspectives and the processes in which they evaluate companies' compensation programs. But that's really all it should be. And the degree to which companies in compensation committees should care about the proxy advisor firm's perspectives really varies significantly between companies. So for example, if you have a high insider ownership level, a large investor, and you know that 40% of your vote is essentially guaranteed on proxy ballots, that might be a relevant point to consider when determining how to execute on the business strategy through the compensation program over the long term. And if that may not align with the pretty narrow policy perspectives of the proxy advisor firms, you may say, who cares? That they're not going to support say on pay or stock plan request or whatever it may be, but we know what we're doing and we are not worried about a low vote here. So we're just going to do what we need to do and, screw ISS and Glass Lewis. But that's kind of one end of the spectrum. Another end is you're a large cap, very widely distributed shareholder base. Optics is really important. There might even be some press related to the proxy advisor firm recommendations. In which case, it's worthwhile to figure out, well, maybe there is a way that we can adjust our compensation program to accomplish what we need to do, while at the same time having the favorable optics from the proxy advisor firms.
Yeah, thank you, Alec. I've found it's always helpful to have a regular communication and dialogue with the proxy advisory firms, both before the proxy comes out and afterwards. And sometimes they don't fully understand the disclosures. And I've had times where, with a little more explanation, they changed their recommendation to something that was consistent with what the board was recommending. So I think that there is a dialogue that can continue to happen. Todd Savage in our group has asked the question, what are the most important issues to consider when you're selecting comparable companies for CEO and I think, full executive comp? So Emma and Jane, and Emma first, how important is it to know what's happening in the market, particularly with peer set companies?
It's very important. I mean, we do a peer evaluation every year. I mean, we're looking constantly, and we are talking about it a lot. What's going on with our peers and their executive compensation plans? Not only our peers, but we also are looking at aspirant companies. It's important to know not just what your peers are doing, but if you're particularly in an industry or at a time in the company's life cycle where you're looking at going in another direction or becoming bigger or better, you have aspirants or people you aspire to be. It's important to see what the compensation there is as well. Additionally, I think you don't need to just look at peers, people in a similar industry, aspirants, but you need to look at competitors for compensation. Now, I know that's a weird term. This is in the Emma term. What that means is you may not have it on your radar screen that there would be someone, if you're, let's say, a furniture company, you may not have it on your radar screen that one of your chief technology officer, for example, is going to be recruited by Silicon Valley. You may not even think about that. So you don't look at them as peers. They're certainly not aspirants. You're not trying to be one of them. But for certain skills and executive level positions, these people can cross industries and sectors. So understanding that they're particularly a hot commodity job like cybersecurity, you need to understand that that is a position that you need to be very aware of what's happening with compensation, not just in your peer companies, not just in your aspirant companies, but industry-wide or globally, because those positions are few and they're hard to get and they're hard to keep.
Love it. Thank you. Jane, thoughts?
I just want to emphasize that last point. It's in Emma, I don't think it's an Emma term, as you said. It's like for us, we call it the talent market. Like, what is the talent market that your people are playing in? And that is often broader than the peer group set that you've set as a committee. And so I think it's incredibly important to be aware of what that is. And the two additional lenses that I like to think about are, one, where do I truly need to be differentiated? So you probably don't need to be paying top dollar against talent market for every single role at your company or for every executive, but like, who are your make or break people, either from a succession planning perspective or a product differentiation perspective. And then the second thing is just thinking about, make sure you're not overly reactive either. Just because you see one or two companies starting to do something, pay attention, but know where you need to make a move or when you need to make a move. Because compensation is one of the most personal things that we do for somebody. It's also, for most companies, if not all, the biggest expense that we have. And so just being very thoughtful and plotting, like, when do I respond and what are my gates that kind of trigger me to say, I think we may need to make a change. Because there can be, with some of these up and coming Silicon Valley companies, a lot that comes out quickly and you may not need to respond. because, what you are doing may be effective with the talent that you have.
I love it. And one of the questions I will frequently ask as a compensation committee member is, will management be happy with what we're doing? As you noted, Jane, you don't want it to be a negative. You want to see where the peers are, but you want to make sure that when people, either the comp committee chair or the CEO, whoever's delivering their comp to them, that there's an excitement to keep slugging away the next year. And so I think that's a really important question.
Yeah, I'll just add to that topic briefly that there should also be a fair amount of realism and practicality with regard to peer selection. And I'll tell you why. Let's say people want to include a bunch of companies that are 10 times larger in market cap than your company. That's fine. There can be an argument for talent competitor, for relevance of business fit. Maybe it's one of the few competitors in whatever space the company is operating under. But it's not necessarily going to produce the most useful compensation benchmarks, because a company that's 10 times larger in market cap means it needs to dilute its shareholders 10 times less than your company to provide the same grant values. Usually one or two outliers are okay, but it can lead to a reduction in the usability of the benchmarks if there are a lot of companies that are outside a pretty typical size range relative to your company.
But Alec, doesn't the concern that you're going to get negative say on pay, or you're going to get negative feedback from Glass Lewis and ISS, doesn't that help you avoid going for the ridiculously far outside of your range?
It sure does, but I wouldn't necessarily always lead with that argument, because that's there could be other reasons why proxy advisor firms or shareholders don't like a particular set of peers. The first kind of principle that I try to operate under is this going to give us useful benchmarks to based on which we can make valid compensation decisions, and everything else is somewhat secondary.
Good discussion. The market continues to reach new highs, but perhaps absent the Magnificent Seven or the Fab Five or whatever those few that seem to be driving the market are, there are a lot of companies that are struggling with stock price, and that there'll be underwater options. There'll be, it takes more stock to get to the same level of compensation as it has in the past. Alec, how are you advising companies you deal with that have stock plan share constraints when they don't have enough shares in the plan?
Yeah, so this one has been coming up pretty frequently. In our work with growth-oriented companies and recent IPOs that saw their share prices go up a lot during the pandemic boom and then came down pretty hard. So I'll touch on some of the strategies that we've implemented or discussed with clients recently. We actually have a list. So if you're taking notes, it's time to get your pens out. Strategy number one, bifurcating or delaying the annual refresh grant until new shares are approved at the annual shareholder meeting. Number two, reducing LTI participation at lower employee levels by only granting to high potential or high performance individuals. So maybe if there's an employee rating scale, 1, 2, 3, 4, 5, and previously eligibility started at performance rating 3, some companies may be thinking about, well, maybe we're going to move that to starting awards at only performance rating 4 and 5. And then another strategy is just reducing awards but offsetting that reduction by one of the following actions or multiple of the following actions. Reminding employees that it's the stock price on the date of vesting that ultimately matters, not on the date of grant. Switching to communicating awards in numbers of shares instead of grant values. Shortening the vesting schedule. Providing a portion of the LTI in cash-based awards. Offsetting a portion of the reduction through a higher salary merit budget and or bonus pool. Increasing 401k benefits. And implementing an employee stock purchase plan if there isn't one already. And last point on this that I'll make is, companies are often really concerned with what, when going out for new stock plan share requests, are concerned about what will be the reaction from the proxy advisor firms. Will ISS and Glass Lewis support the request? And it all but guarantees that the share request will pass if ISS does support the request, but it's not always necessary. Going back to the example when there's high insider ownership, that can buy some flexibility to ask for a 3 to 5 year share pool instead of a 1 to 3 year pool, which may be supported by ISS. There's ways to sort of gauge whether it's a valid strategy to consider going around the proxy advisor firms for stock plan share requests. The institutional shareholders, the large ones, all have their own processes through which they evaluate share requests. So if you keep the share request reasonable, it may not always be worthwhile to spend the money and the effort to make sure that ISS will support it.
Great. Any comment, Jane or Emma, anything to add to that discussion about stock plan constraints? There's a question that came in from Kerry Vance in our audience today. He said, how do you balance reward or lack thereof and retention when it comes to annual bonus approval and underwater options? Often when a company's stock doesn't perform, you want to hold leadership responsible, but you also want to make sure they feel motivated. So, thinking about what Kerry's asked, how do you think about different types of equity and equity vesting schedules? Jane, any thoughts on that?
Yeah, I think particularly being, public, I think most of us are trading in RSUs or PSUs. That's kind of what our equity types are. I think the biggest tool that we've found in balancing this is, first, though there's two. There's the first and foremost is what you said, Jonathan, is management going to be happy with this? You can't assume that whatever the solve is for one leader is going to be the solve for another leader. So you have to really work with your leadership team and understand, do they even understand what the motivators are of every person? But the second is making sure the leadership team is really crystal clear for themselves and anybody else participating in the equity plan about what's driving stock price, whether it's in their control or whether it's not. I think we have to be super clear about what is in our control and what are we doing and how are we regularly communicating our progress towards that and what we believe has to be true for this to turn around. Because if you're working with the management team to help craft this storyline, and many of you have you're part of these committees because you have a broad array of experience, so you can help craft this storyline with your management team to say, this is what I believe has to be true to turn around. How are you delivering that message? How are you communicating that to motivate people? Because these are often executives, they want to win. And if they see what the path is to winning, they're going to believe that their compensation upside is large. And then it goes back to tying it to what Alec, you said, is reminding them that it's the value on vest that matters, not the value today. So how do you tie all those things together? And it is work. It is a lot more work than it is when you can just simply say, this is the value today. So that's kind of, I think it's all in the messaging and how you're bringing the leadership team along with you.
Great. Emma, any thoughts on different types of equity, vesting schedules, those kind of things?
Yeah, so in terms of long-term incentive, particularly when you're looking at stock that's fallen, and it seems like it's not an incentive, but it is an opportunity, because if the stock price has fallen, you can get more of it at a lower price. And if you have, faith that you're going to turn around whatever the situation is, and that stock price is going to grow, sometimes it's not always a downer. It's not always a downer, particularly for the leaders who say, okay, this is temporary, the market's undervaluing us, bring it on, give me the equity. I know we're going to have that hockey stick growth. It's going to turn around soon. But in the meantime, really determining what are the things that are going to drive the performance that we need to have in order to see that stock price go up. You got to retain the talent, right? So if you look at the LTI, you've got, performance restricted stock units, and then you've got time-based. One way you might be able to address it is, do we move more into time-based so that people know that we want to have them here? They believe that it's just a matter of time before we get the stock turned around. So let's, the performance metrics aren't going to be there in the short term. Let's move more of that LTI into time-based. So that's one lever. At the same time, I think you've got to look at short-term performance metrics. How can we kickstart whatever it is that's not working right now to deliver the performance we need? So you may have to look at quarterly bonuses. One of the things that I've done at some of the companies I've worked with is we have now implemented, instead of revenue and profit, we've cut out about, where 15 to 25% of that bonus to be what we call strategic goals. Strategic goals are more or less, profited. It may be about increasing the sales force if that's what is needed to drive performance. That is, you have some numerical goal there that you want them to achieve. If you need to get a certain amount of customers in a short period of time in order to do that, then that would be a part of a strategic goals. But it really will depend on the situation. So in that instance where you have the stock price declining, as a potential disincentive, I think there are several levels you can pull, including rebalancing LTI between time-based and performance-based, looking at even short-term incentives that might get you to where you need to go, because you may need to just do some things in the short term faster in order to drive that overall performance. But ultimately, you do want to see the shareholder value go back up. You want to correct whatever it is that's wrong. And it's a matter of understanding what are the things that are going to drive the performance that you desire and making those adjustments.
And great comments. Jane mentioned that most public companies use restricted stock units and performance stock units. There are some that continue to use stock options. My experience is that when stock options get underwater, that's of concern to institutional investors who know that management may take bigger risks to try and get the stock options back in the money. And if they're too underwater, those risks can be too big of risks. And so I think if you're looking at using stock options, look at using a mix of different type of equity. Performance stock units, which are fairly common in long-term incentive plans, and restrictive stock units, which are going to vest one way or the other to keep management motivated without swinging too big for the fences on a high risk, high reward effort. There have been some interesting questions that have come in around the Elon Musk comp package. Lisa Padilla of our audience says, do you feel that the Elon comp package will change the proxy approach to comp? And Christina Koga has asked, what are your thoughts on best practices on the recent discussion on Elon Musk compensation at board level? Things to be taken into consideration in similar situations at your company. Well, if you have a similar situation as Elon Musk, good for you. That's a very different CEO than I think most of us deal with. But Alec, what are your thoughts as a compensation consultant? I'm sure you've begun to be asked even in the short time since the changes, since the Tesla approvals.
The biggest takeaway from this is really highlighting the focus on process. Process and procedures and governance when it comes to doing things that are meaningfully outside of the norm. The judge in this case, the kind of most significant allegation behind the decision to rescind the compensation package was that the board's process and approach was not sufficient, in that Musk had too much control over the board and too much influence in convincing the board to award this compensation opportunity, and that it wasn't done in a transparent way for shareholders. I actually did have an opportunity to work with a company on an outside of the box moonshot type of award this year, while the Musk issue was in the headlines. And there was a significant effort to make sure that everything was done properly, that outside counsel was involved from an early stage and continued to be involved, and that the compensation consultant was involved pretty meaningfully. And then the documentation of all this in the proxy statement was very thorough. So, I'm not going to comment on whether the Musk award was appropriate or not. That's, largely a business decision. But everyone in the exec comp and corporate governance world has just become a little bit more aware of following the right process and making sure it's documented and then disclosed properly to avoid having, undesirable legal or shareholder issues down the line.
Yeah, I'd like to talk a little about trends and best practices on how the different parties involved in setting compensation, specifically management, comp committee, consultants, work together. It's really there's a lot of parties involved here, and you want to make sure everyone is getting input and it's working best. Jane, how do you do that, and what best practices are you trying to follow as a member of management to try and get this compensation right and approved?
I think there's a few things, and I think the first starts out with how do you form the foundational partnership? And so I think we have an amazing board, an amazing comp committee that makes this very easy for us to do. They're always available to talk between meetings. And I think that between meeting time is incredibly important, because we've developed such strong relationships. Everybody on the committee, whether you're on management or whether you're a committee member or whether you're a consultant, everybody knows kind of what your areas of expertise are and what your focuses are. And so across every party, we make it a point to articulate those to each other regularly and catch up between meetings to dig deeper with specific people on the topics that we know that they can maybe add additional value on, or that they it's going to be a hot button for them. So by the time you get to the meeting, nothing should really be a surprise. I think one of the other things that we've also found very, very helpful from a management side is aligning and revisiting the calendar and the agendas on a regular basis, so that committee members who maybe are thinking about something that's very top of mind for them, they know when it's coming and they don't derail kind of the topics that are at hand, because they know that that's a topic that we're going to dive deep on in August, and I'm going to have plenty of time to contribute to that. I don't need to really take a sideways conversation in May to address that. But for us, it's like I said, it's really that in-between time, and having a board that is willing to pick up the phone as needed.
Love it. Emma, your thoughts on how these different groups work together and work together best?
Communication. It's really important that everybody is aligned around what the company's strategic goals are, long-term, short-term goals, and then also are communicating about the compensation that is expected, particularly at your NEOs. For example, the comp committee should be talking to the management team a lot. What are you seeing in the marketplace? What are you hearing out there? Are you getting calls? Are you getting calls about, trying to get your way? You keep the communication lines open. Are you having to bring in somebody? Are you having trouble with recruiting? Are you finding that, our offers are low, high? Where are we? So you got management's perspective, get the advisory firm consultants perspective as well. They'll go out and do a very detailed analysis, and they'll go out and look at all the market publicly available information, as well as what's happening with their other clients. So they'll provide you with an outside perspective. Additionally, I find that, being on a couple of boards, I'm understanding what's going on in other industries with regard to compensation for particular positions. And this is some, bringing non-private information, into the conversation as well. So it really is important that you're communicating all the time. Even though our comp consultants, work with the comp committee, we encourage them to talk to management. We encourage them to meet with management. We encourage management to reach out to them. So it's about making sure that you keep the communication lines open. And as Jane suggested, we have a lot of meetings. We are not just waiting to have the comp committee meeting right before the board meeting or right after the board meeting. Whatever, if things will come up in the interim, and it is important to get all the right parties on board, on Zoom, whatever, to address things as they come up, not to wait till a meeting. It's also important not to have any surprises at a meeting, as Jane mentioned. So I do think communicating is very important, and not having walls up between the different groups, making sure that people feel free to reach out to somebody without a formal invitation to do so.
Communication always makes things better.
Can I have
Al,
one more
can
point
you-
to that, Jonathan? Which is like,
Please.
so it's, there's communication, and one of the things that you talked about, Emma, is just knowing management's view on people. And I think it's good for comp committees and boards to sit down and say, how am I structuring different conversations in different committees? Because I know every board does it a little bit differently. For us, we have found it incredibly helpful to fold all of our talent conversations into compensation committee. And I know in other boards, maybe there's a talent committee, or maybe that sits in another place. But I think it is incredibly hard for a compensation committee to like come to the table with an informed opinion to have a conversation on if they aren't really also super familiar with all those broader talent conversations around succession planning, et cetera. And so that's one, like, if you're on a compensation committee and you're not getting that information today, I think it's worth like taking a step back and saying, like, would it make my job easier? And how are we facilitating this dialogue?
I just want to put an exclamation point on that. And at Smucker, we recently changed the name of the compensation committee to the People and Compensation Committee. It has to involve that. Alec, how do you talk to us from the consultant perspective, and how the compensation consultant can best be used and best likes to be used?
I wholeheartedly agree with all of Jane and Emma's comments. There absolutely must be a strong partnership between the consultant and management while the consultant advises the compensation committee. Jane mentioned earlier that compensation is very personal, and that's true. So there has to be buy-in from management if there's going to be meaningful changes to the compensation program. Otherwise, it's not going to be very effective, and it could lead to contention between management and the compensation committee or the broader board. So definitely agree with operating by the principle of no surprises, doing the pre-work, being prepared well ahead of the meetings. And there are going to be times when there are disagreements or differing perspectives between either the consultant and management, or management and the comp committee. But if there's time and a process to understand those differences and begin to work through them ahead of the comp committee, that's really the goal. So yeah, fully on board with the partnership aspect. And, most of the comp committees that I advise, they are also, they're pragmatic about it. And a lot of them have been in the management seat and understand that it's really important.
Great, I love it. Thank you so much for that. We've had a question come in from Elsa Nang about early stage companies. So we may not have the exact expertise here, but I'll ask it of this group nonetheless. Are you seeing an uptick, particularly since COVID, with the use of fractional CXOs? What observations regarding compensation for these part-time executives would you highlight? And are there publicly available resources for benchmarking you'd recommend? Anyone on the panel want to comment on fractional CXOs and what they're seeing, if anything?
I'm not seeing with the companies that I work with directly, but I am hearing in the market, people at smaller startup companies, that is certainly, I'm hearing a lot about that.
Alec, any comments?
Yeah, from a compensation perspective, there just isn't a whole lot of good benchmarking data at the early stage in general. So when evaluating compensation for these fractional leadership positions, corollaries could be the company's approach towards high value consultants, which are often in use at this stage. As well as advisory board members, and then just going by kind of what feels right based on internal equity.
Yeah, I agree. I also think it has been factored into some of the places I've been. Annual incentive plans, getting a fraction of that, long-term incentive plans, marking them down based on the time they're expected to spend. I'd like to spend our last few minutes before I ask each to wrap up on how incentive plans and compensation impacts culture. Peter Drucker famously said, culture eats strategy for lunch. And I think so many of us on boards are charged with being keepers of the culture and making sure that goes forward. Jane, I know Traeger has a special culture, and Jeremy, your CEO, is one of my go-to culture mavens. How does compensation drive and or reinforce culture?
It's not the only lever, I think, first of all. And so I think one of the things that we do when we're screening for a hire at a senior level, if their top motivator, only motivator is compensation, we quickly realize that they're probably not a fit for us. And so it's kind of knowing what you're looking for as you're bringing people in and screening for, are our values aligned with theirs? The second lever that we look at is, from compensation and driving culture is really leaning into equity. So we have chosen to have an equity heavy pay mix relative to market, because what we're looking for is people who want to be part of a community, who believe in the brand, believe in what we're building, and want to be here for a period of time. So we do lean more into time-based equity versus short-term incentives, because we believe that there is upside. We want to hire people that believe there is upside, and that are going to stay here to build that culture and build that long-term vision for us.
Love it. Emma, anything you'd want to add to that? How does compensation drive or reinforce culture?
The ends do not justify the means. We are not Wells Fargo trying to get, sales. I mean, there's been a lot of examples in the past where incentives that are not managed well has driven some bad behavior. And I do think that it is important that companies reinforce not just what gets done and what results are delivered, but how they're delivered in line with the expected behavior, values, traditions of the business and the company. And that kind of what they call soft skills or soft metrics are also valued highly as well. And so it's okay if you want to say, let's go get it, but let's go get it in a way that is consistent with the company's values as well as the law. You know, let's just not go get it by any means necessary.
Yeah, I think that's important. And I've seen compensation plans that insert softer metrics into part of the annual or long-term incentive plan, softer metrics that build on culture. They don't necessarily show up in the P&L or the balance sheet, but they're measurable softer metrics that help culture. I think inclusion, I've seen that as one that's been really important for some companies, and they want a bonus and incent people on them. You know, speaking of incenting people the right way, Alec, what type of metrics have you seen being used in setting compensation and incentives? And has culture been factored into that as you've advised different companies?
Yeah, so it really depends on the type of industry and the size of the company. The approach that I usually suggest taking when having a discussion about what metrics are appropriate is, what is the business strategy? What are we trying to accomplish over the next 1 year, 2 year, 3 years, 5 years? And how can we work those goals into the incentive programs? It's often a lot easier to do for annual bonus plans where, you only have to set a goal that's going to be good for 1 year. Most companies can do that. The challenge often is with the PSUs, which, are typically measured over a 3-year period. So, to the extent that you're setting long-term goals, look at your business plan and see if it makes sense to put in something that aligns with the long-term plan of the company and is supportive of the culture, and will be viewed as motivational during the entire course of the performance period, which may require, like I mentioned earlier, setting those performance ranges from threshold to maximum wide enough to account for possible volatility and unforeseen events during the performance period.
I've got a couple of metrics that, not at the companies I'm at now, but at smaller companies I've worked with over the years have used. And one is Net Promoter Score. If you're a company that it's important for you to grow customers and to get repeat purchases, that will drive your revenue, that will drive your profitability. Net Promoter Score is a really good way to understand how customers are perceiving your brand and your product. Employee satisfaction scores, will be a good indicator of, are the people happy? Do they feel valued? Do they feel, compensated correctly? Do they, are they aligned with the company's mission and vision and values? So there are some, what they call soft metrics that are really easy to measure. I mean, you can come up with you can measure sentiment of employees, sentiment of customers that will impact the future viability of a company.
Yeah, I love it. I love it. Jane, anything else you'd add on metrics?
I think the only other thing I'd add is, and I'm not going to pretend to know the answer here, and Alex, I don't know if you have anything to add to it, is how do you consider setting the same metric for everyone versus how far do you break it down to be individualized by role? Because if you think about culture-wise, which is, clearly in my seat, something I focus on, there's something beautiful about having everybody unified around one vision. But at some point, you do need to break it down into individual metrics that they actually feel like they can control as well. And so I'm curious what trends, Alec, you see in the mix of the metrics that you see used within a single company.
Yeah, that's a great question. The trends for corporate level executives like CEO, CFO, general counsel, head of HR, they still tend to be on a uniform bonus plan where they are measured on the same metrics in the same manner with little to no individual performance factor for their bonus, because they're viewed as ultimately responsible for the company's financial performance. Looking at business unit heads who are executives, tend to be differentiated metrics there, where maybe you have a weighting of 50% on the corporate level financial performance and 50% on the business unit performance. And then going down below the executive ranks, that's where you tend to see kind of a sliding scale of increasing weighting on the individual performance factor, under the philosophy that the lower down you go in the employee level, the less control they have over the sort of high level financial performance results of the company, and the more you need to incentivize them to hit their individual performance goals.
Love it, love it. And I think it's important to have easily reportable. As the CEO, I loved it when they were simple. If it was net income, if it was growth in customers, if it was EPS, things that people understood how they could impact. The more complicated than financial the metric got, I think of return on invested capital is one that, CFOs love, sometimes investors love, but you ask someone on the front line how they impact ROIC, they say, what? I think having something that I could report and put on a burn up chart or a thermometer, here's how we're doing, put on a graph above or below plan, that motivated people. So I think metrics that are easier to understand and easier to report without having to involve your CFO to give some complex algorithm are really important. We've had great questions come in. I'm sorry we haven't gotten to all of them. We didn't get to all of my questions, some of which I thought were great, but it was great to have everyone. I'm going to close by asking just for a short final comment from each of our panelists, and we'll go in reverse order of introductions. Alec, anything you'd like to finish with?
I just want to reiterate, some of the comments about compensation programs and incentive design being impacted by culture and business strategy. That's really true. My approach towards consulting is, yeah, the market data are important, they're relevant, but they're just data. They're a platform. They're not the answer. And the answer is, it takes a little more work to get to where everyone, all the stakeholders will feel like it is the right approach.
Thank you, Alec. That's a great capstone. Jane, what do you want to add at the end?
As I think about the partnership between management and the committee, I think there's a lot of value in the input on the mechanics and the numbers, but where the real value comes in is you taking your background as people leaders, as operators, and pushing on management to say, are you thinking around the edges of the numbers? What is the person motivated by? What are you holding them accountable to? Are you giving them feedback? Because compensation is it's only one lever to drive towards the success. If you aren't pushing and helping kind of management make sure they're covering all the other angles, you're not getting the most out of your compensation. So don't minimize the role of compensation to just compensation.
Thank you. Perfect. Emma?
Benchmark, understand what peers are doing, aspirants are doing, what's going on in the marketplace, communicate, make sure that the comp committee, consultants, management are in regular and direct communication. And finally, respond, be responsive to what you learn. Believe it or not, there are people who get all this information, they communicate well, but then they don't want to make any changes to address what they're seeing. So be ready to respond so that you can see the differences that you're seeking.
Thank you, Emma. Great. Emma, Jane, Alec, thank you for participating today. My final comment is we talk about getting compensation right and how important that is. Getting it right is not a one and done event. What's right for this year may not be right for next year. Compensation is iterative and needs to be thought about anew frequently. Thank you all for participating.